Welcome to Ben's Fireside Interviews. Today we've got Phil Langham from RBC Asset Management, one of the world's biggest GEM markets, that's global emerging markets investors. It's a proud moment for me because I've known Phil for over 20 years now. I'll give you a little bit of an introduction, but I'm going to let Phil talk about why he found his way into emerging markets and his thoughts on the asset class from there. So Phil's been an emerging markets fund manager for over 30 years, and for the last 16 years has headed up the RBC Emerging Markets Equity Fund. This is one of the largest funds for emerging markets in the world at just over 28 billion. I'm sure Phil will correct me if that's not correct. Phil's also run emerging markets funds at Soc Gen Asset Management, at Credit Suisse in Zurich, as well as the Kuwait Investment Office from the London office. So Phil, why did you get into emerging markets? And what are your sort of general thoughts right now on where this asset class should sit in a, if you like, holistic global asset allocation model?
Yeah, hi Ben, great to speak with you again. So how did I get into emerging markets? After university, I qualified as a chartered accountant. At that time, chartered accountancy was a great route into finance, and I knew I wanted to get into finance. And after qualifying, I went traveling through Asia. I really fell in love with the dynamism, the optimism, the hope for a better life, the diversity. So I decided I wanted to try and combine finance with emerging markets. I was very fortunate to get a job in fund management doing emerging markets some 33 years ago. If I'm honest, at the time, I didn't really know what fund management was, but it's turned out to really suit me, and I've absolutely loved every day of working in emerging markets since. In terms of your other question, so where should emerging markets sit within an overall portfolio? I'd say really the way to look at emerging markets is that it's a diversifying asset class, slightly different from developed markets, tends to have somewhat different cycles. What we've seen historically is that often when emerging markets are doing very well, developed markets can be doing much more poorly and vice versa. And that over the long term, emerging markets have tended to grow much faster than developed markets. Obviously not surprising, given where we are in terms of much lower penetration, the ability to catch up in terms of technology, generally much stronger demographics.
Thank you for that. So I'm going to touch on a few of those points. Now, emerging markets as an asset class, and I'm looking at the MSCI dollar returns this year, they've been almost 30% or so. So very strong performance, and certainly better, I think, than a lot of developed markets. But it feels to me that over the last 30 years, emerging markets, very few of the emerging markets have really emerged, if you like. And that asset class still contains pretty much the same countries as they did so many years ago. So what's happening in this dynamism? Which countries are winning? Which countries are losing currently?
Yeah, what I'd say is that essentially emerging markets are defined by GDP per capita. And essentially the lowest GDP per capita countries tend to stay as the lowest, even if they're growing faster. But what we have seen, if you look at emerging markets overall, is that in terms of GDP growth, they have tended to grow considerably faster than developed markets. And if you look at global GDP, let's say 20 or 30 years ago, emerging markets 30 years ago represented about 20% of global GDP. Currently, that's nearer 55%. Emerging markets represent around about 80% of global growth. Virtually all the working age population growth that we're seeing is coming from emerging markets. What we also see is that at different times, different emerging markets are doing better. So some 20 years ago when commodities were very strong, we saw that Latin American markets and China in particular was growing much faster. In the last decade or so, we've seen much stronger growth from areas like India. With the technology boom, but we've seen countries such as Taiwan and Korea really prospering. So different countries will do well at different times.
I'm going to come back to some of those points because there are issues around potential concentration risks, etc. But we'll touch that in a moment. In generic terms, the sort of challenges that I remember from an emerging market perspective were really around much tighter liquidity in terms of the stock markets, lack of corporate or political governance, volatile currencies, and potentially also lack of judicial stability, if you like. So how are you at RBC avoiding these pitfalls, and which countries are better than others, if you like, when it comes to these potential challenges?
Yeah, I'd say, first of all, for us, a lot of work is very focused on companies, on management, on owners. We feel that it's very important to find management that we can trust, management that are driven to succeed, management that are entrepreneurial, management that really do take a long-term view. You're right, you also need to consider top-down aspects, top-down risks, think about political risk in particular. So a great example would be that going into the Russia-Ukraine crisis, we had zero exposure to Russia. Now, we didn't predict the Russia-Ukraine war, but we did recognize that in a country like Russia, political risk was particularly high under Putin. So you do need to think about these factors. You're right, liquidity is also definitely an important consideration. I'd say we have seen liquidity improve a lot, but it is also important with emerging markets to make sure that you don't get stuck in any sort of holding that you're not able to sell.
So when I think about emerging markets, I think of almost like inverse correlation to a strong dollar. So a strong dollar results in a weaker emerging market performance. That lower rates in the US are positive for the same reasons for emerging markets. And again, potentially inflationary drive in the US is also positive for commodity-led emerging market countries. Do you, and I'm not going to put words in your mouth, but it feels that when you put all that together, despite this year's strong performance for emerging markets, it feels like we're going to see more of this going into next year as we see a potentially quite a dovish Fed kicking into place from May of next year onwards.
Yeah, you're right. Generally, what we've seen historically is that emerging market relative performance is stronger in a weaker US dollar environment than a stronger. If we look at the US dollar until this year, in the last sort of 10 or 12 years, it's generally been strengthening, and that coincided with the relatively weaker performance from emerging markets. Whereas between 2001 and 2010, we saw that the dollar was weakening, and in that environment, emerging markets produced very strong relative performance. What we've tended to see with the dollar is that, like emerging markets, the dollar tends to perform in quite long cycles. What we've seen with these cycles is that typically at the bottom of these cycles, such as in 2010, the dollar looks extremely undervalued, and at the top of these cycles, such as was the case last year, the dollar looks very overvalued. Our thoughts is that the dollar has never been, or there's only been one occasion going back 40 or 50 years where the dollar was as overvalued as it was at the end of last year. We would say that there's also other factors that would support a weaker dollar going forward. So we have a very large and ballooning current account deficit and fiscal deficit in the US. And it's also very much Trump's policy to see a weaker US dollar going forward. So we would say that the case for the dollar, which has started to weaken in the last 12 months, but the case for that dollar to continue to weaken, we feel is very strong, and that would definitely support better relative emerging markets performance going forward.
Yeah, makes sense. Let's turn a little bit to the components within global emerging markets. And again, it's very easy to think of this universe as a very differentiated by countries, by different types of companies, by different sectors. But in reality, there is a significant concentration. A little bit like Mag 7 in the US, there is almost 25 odd percent of the global emerging markets in 10 stocks. These stocks tend to also be quite technology related. So how do you, as a fund, work around that? And how do you work with concentration risk?
Yeah, I'd say what's important when it comes to the concentration of our own portfolio as opposed to the concentration of the index is that we are comfortable with the stocks that we own. We believe in the stocks that we own. And we'll obviously do a lot of research on those stocks. We do believe in a relatively concentrated portfolio. So typically our portfolio size is about 45 to 50 names. But I'd say that we get, in terms of our top 10 position, typically about 40% of our portfolio would be in our top 10 positions overall. And we do a lot of work and have very high conviction on those. It's also important, and you touched on this, Ben, to think about top-down diversification as well. So diversification in terms of sectors and in terms of countries. So that's also something that for us is a very important part of what we do. We actually have one person in our team completely focused on risk, and we do feel that's something that is really important.
Can we talk a little bit about the team? What is the sort of research process? Presumably there's a lot of kicking of tires, traveling extensively. So tell us a little bit about your research process. Tell us about the team, how you operate.
Yeah, so we're a 12-person team. What I've looked for in terms of building up the team has been to try and find people who are naturally intellectually curious, people who are humble, people who are focused on continuous improvement. But for me, the most important factor has been to find people who are team players. We're a very diversified team. We're diversified in terms of gender, in terms of background, in terms of experience. And for me, that's been really important in terms of how we work. I haven't wanted a bunch of people who'd be very similar to me, who would always agree with me. But this culture of diversity, of lots of different views, of people really challenging each other, lots of discussion, lots of debate. I'd say that for us is really important in terms of how we work. We're all based in London. We all have a lot of our discussions and meetings together in London, but kicking the tires is something that's very important for us. We won't invest in any company without meeting management. We tend to meet management several times, and at any one time, there's always people in the team traveling. Because of, I'd say, the research that we do and the sort of focus that we have when we meet with companies, company management actually tend to enjoy meeting with us. And a lot of our focus when we meet with companies is on, I'd say, very long-term sort of factors. So the culture of companies, strategy, long-term competitive edge. And these for us are all the sorts of things that we feel are really important and where we would tend to concentrate our research.
Can you talk a little bit about sort of the valuation differential between developed markets and emerging markets today? And clearly within developed, there is a vast gap between where US trades and where, say, Europe trades. But where does emerging markets generally fit within that?
Yeah, what we've seen over the last few years with developed markets outperforming emerging markets is that the valuation discount of emerging markets compared to developed markets has widened, and in price to book and PE terms is something like 40%, 40 to 45%. So quite a significant discount and close to its all-time high. What we have observed in terms of valuation is that valuation doesn't tend to be a great predictor of shorter term performance, but is a much better predictor of longer term performance. And I'd say that's particularly the case with developed markets, actually. If you look at what valuations would say at the moment about the US market, what we've seen historically with the sorts of valuation levels that we're at the moment is that on a 10-year view, we've always had negative returns from the sort of valuation level that we're starting at for the US market. Now, that doesn't mean we will definitely get that over the next 10 years, but it does indicate that perhaps that's something that people should have on their minds.
When we think about, and I'm not going to draw you into a discussion about individual stocks because I know you can't do that, but coming back to this concentration issue, and when we look at these top 10 stocks that include clearly the likes of TSMC, Samsung, Alibaba, Tencent, there is a certain level of country concentration within those, but also there's a certain level of sector concentration. Now, we know that the technology sector is trading at pretty punchy valuations in the US, partly thanks to much better growth in earnings, so that's justified. But where do you think the risk, could there be a sort of a risk profile that comes from a kind of left field, if you like, that was the expression I was looking for, that attacks emerging markets, not because of anything going on in emerging markets per se, but because there's a sort of negative run on technology stocks in the US?
Yeah, so first of all, in terms of emerging markets technology, it's about 30% of the overall index. What I'd say would perhaps differentiate a lot of the leading emerging market technology stocks from those in the US would be that essentially a lot of the way that a lot of the technology companies have benefited in emerging markets is really by being the supply chain to a lot of the big US companies. So you mentioned TSMC, but emerging markets would have a lot of the leading semiconductors. And I think the best way of perhaps describing it is that really, if we're thinking about AI growth, we could think about the emerging market companies as being basically the picks and shovels of that growth. And they will benefit overall from the long-term growth that we're likely to see in tech in general and in AI. One of the risks that they won't face is that I think perhaps over coming years, we're likely to see in the US winners and losers emerge from the sort of AI growth that we're seeing. Whereas emerging market companies themselves will tend to benefit just from the overall growth that we're likely to see. While emerging market tech companies have done well in the last decade, they haven't done anywhere nearly as well as those in developed markets, particularly the Mag 7 stocks. And there is quite a big valuation gap. I'd say that if you look at EM tech, we are trading at the high end of long-term ranges, but not an unusual level of valuation. Clearly, that's not the case in terms of US tech. The other thing I would say is that certainly as far as we think about the portfolio, we do see ourselves long-term risks in terms of tech, and we're slightly underweight in tech, and we've gradually been reducing. We feel that really the interesting story in emerging markets is much more in domestic stocks. We're seeing areas like the EM consumer, EM financials, really have very strong prospects. And I say particularly in a world where there's a lot of uncertainty in terms of exports with tariffs, our view would be that the case for focusing on domestic stocks, domestic sectors in emerging markets is even stronger.
So which countries would you say have the best opportunity when it comes to domestic demand, domestic consumer growth?
I'd say that the countries tend to change. So at any one time, there'll be some countries that are doing better than others. A good example would be we've always been big fans of India. India has tended to grow faster than a lot of other emerging markets. It's coming from a lower base. Penetration in a large number of different areas is lower. So, for example, if you look at mortgage penetration in emerging markets, mortgage penetration in India, it's around 8 or 9%. That compares to about 25 to 30% in most emerging markets and about 80 to 100% in developed markets. There's also a lot of great, really well-run companies in India. Having said that, we saw that after a very strong run of performance in India, about a year ago, valuation got very expensive. And our feeling would have been a year ago that India was perhaps a market to be a bit more cautious on. We have actually seen India underperform quite a lot in the last 12 months, and we're starting to feel that India's again beginning to look very attractive.
Interesting. By the way, very grateful to you for taking more than 20 minutes to get to AI, because most people jump into that straight away. Just coming back to the sheer size of your fund, you are now one of the biggest, if not almost the biggest, emerging markets funds in the world. I guess two questions here. One is, how did you manage to get to this size? There are lots of emerging markets funds out there in the world, but you've been incredibly successful at doing that. And the second is, how does size create challenges for you in terms of changing your asset allocation strategy?
Yeah, I'd say in terms of how we got to where we did, I'd say for us, we have a very consistent and disciplined investment process. And when people look at the results, they can really see that consistency. We also put a huge effort on research. We're happy to share our research with a lot of our prospects and clients. And I'd say for them, that's something that's very important. I think the focus that we put on risk, the focus that we put on corporate governance, again, resonates, we find, with a lot of investors. And we're very open about having everyone in the team be involved in terms of meeting clients and prospects. We even often have clients and prospects join some of our meetings just to get a feel for the sort of culture that we have. As I said, it's a real culture of learning, of continuous improvement, and very much of consistency. So these are all things that I'd say have tended to resonate with a lot of consultants and clients and have helped us to build this business. We are very cognizant of capacity, and for us, performance is the most important factor that we think about. We've been doing an annual capacity study for about a decade now, and we want to make sure that as we grow, we're able to manage our portfolio in the same way when we're at a low asset base as when we're at a much higher asset base. We do still feel that we've got some room to grow, but we also will be very disciplined in terms of capacity, and we will shut off the fund if we feel that we're not able to continue to get the same performance with VA that we have. So that's something that we very much do think about.
Okay, thank you for that. If we do think about liquidity, what are your current thoughts on a subset of emerging markets known as the frontier markets? Are these, by definition, better growers? Are they areas that we should be looking at and concentrating on going into next year, or it's still too illiquid and not necessarily growth bound at this juncture?
Yeah, I'd say the case for frontier has historically been that they're not as well researched as emerging markets. Essentially, they're the emerging markets. And that also they should be faster growing than emerging markets. And there was quite a lot of focus, I'd say, on frontier markets about a decade ago. We've seen quite disappointing performance from frontier for the most part in the last decades. I'd say that economic management in a lot of these frontier markets has been the prime reason. They've also suffered from currency instability, from higher political risk issues, and very few have really done well. Perhaps the one obvious exception would be Vietnam, which has continued to grow, continues to do well. It has also had its ups and downs, but it's perhaps been the most, I'd say, successful frontier market, and it is one that we are looking at. We don't actually have any exposure there at the moment, but it is definitely one that we are looking at, and feel there's a reasonably strong chance that over the next 2 or 3 years that it could actually be upgraded to emerging market status. But I'd say outside of that, a lot of the frontier markets were in Africa that have had political issues and have been quite difficult in terms of liquidity. Definitely it's been an area that I'd say has been overall somewhat disappointing over the last decade.
Yeah. No. And in terms of when I think about countries that we don't want to go and invest in or certainly be underweight towards, clearly countries like Russia remain uninvestable, but where would you be underweight going into 26 at this juncture?
I'd say for me, it's more of a case of thinking about which sectors we'd be underweight rather than necessarily which countries. We tend to be more underweight in cyclical areas, so commodity type areas, particularly energy. We are, as I've touched on, getting a bit more cautious on tech. And also, I'd say, given what's going on in the world, those areas that are perhaps a bit more exposed to export, certainly any manufacturing type areas, would for us be areas to be a bit more cautious on. Whereas very positive on domestic demand-driven areas such as the consumer and financials.
Phil, thank you very much for that. We're just kind of drawing to an end for our discussion, which I found really interesting. How can our family office and investors and folks that listen in and watch our channel get a hold of you and the team?
Yeah, I'd say the best way would be to go through our website, so RBC BlueBay Asset Management. And also in terms of our fund, I think it's on most of the leading platforms as well.
Wonderful. Phil, thank you so much for your time. To all our listeners and viewers, give us the old thumbs up and subscribe to the channel. And at this point, thank you again, Phil, and we'll see you all next week.